If your first 2 years of retirement overlap with a major market decline, your portfolio may never fully recover, even if the market does. Not because it fails, but because withdrawals don't pause. And once capital is permanently reduced, the math changes. Most investors realize this after the damage is actually done. So if you're within 10 years of retirement or actually already there, then this deserves extra attention. I work with investors who've built meaningful portfolios over decades. They've done their heavy lifting, disciplined saving, consistent investing, and patience through volatility. But right before retirement, the strategy must shift. It's no longer about maximizing the upside, but it's about protecting that lifestyle, the flexibility and legacy, especially when recovery time is no longer unlimited. And there's no narrow 5 to 7 year window where structural mistakes do become irreversible. So today we'll cover why early retirement losses hit differently, 4 structural adjustments that will reduce fragility, and a real-world scenario that shows how damage compounds, and what behaviors that determines whether volatility becomes temporary or permanent. Halfway through, I'll give you one sentence that simplifies this entire discussion. If you remember nothing else, remember that. So when you're 45 and making good earnings, downturns are an inconvenience. And when you're 62, withdrawing, downturns, well, those are structural. And here's the issue. Negative returns don't just reduce your balance. They reduce your base, and the future gains compound from a smaller number. This is called sequential risk, which simply means that the order of the return matters more than the average of the return. 2 portfolios can earn identical long-term averages. If one experiences losses in the first few years while withdrawals are happening, it can run out of money significantly sooner. Same average return, different early timing, well, that's a very different longevity to it. And here's one important data point. Historically, severe bear markets have taken 3 to 6 years to fully recover to prior highs. If those years occur at the beginning of retirement and you're withdrawing 4 to 5% annually, recovery becomes much more difficult. And that's where the concern starts to move from theory to reality. But here's the critical shift. The market cycle is uncontrollable. Structure is not. Most portfolios entering retirement are still built for accumulation. Heavy equity exposure, no income segmentation, and withdrawals assume to just work. Well, that's fragile. Income retirement should not solely depend entirely on selling market-sensitive assets. Instead, separate near-term income from long-term capital growth. In practical terms, that means maintaining a defined liquid reserve, hold a lower volatility asset for short-term needs, and structure income layers that reduce forced selling. This doesn't eliminate market exposure. It just reduces the pressure. Let me ask you directly, if the market dropped 25% next year, could you recover 2 years of living expenses without selling equities? If the answer is no, your structure is exposed. In a moment, I'll show you how even small flexibility in withdrawals can dramatically extend your portfolio durability, especially during that early window. But first, let's make this real. Consider a hypothetical couple retiring at 62 with $2 million invested. If they withdraw 5% annually, that's $100,000. In year 1, markets decline by 20%. So their portfolio drops to $1.6 million. After withdrawals, they're closer to $1.5. Now future gains must compound that lower base while withdrawals continue. So if the recovery takes 3 to 4 years, the compounding math is going to permanently be altered. Now imagine the same couple entering retirement during strong market cycle. Early gains can create a cushion. Losses matter less. Same long-term average, but different early sequence. And that leads to a different outcome. That's the fragility zone that we're talking about. So if you remember nothing else from this video, remember this. Early losses plus withdrawals are more dangerous than volatility alone. That single principle drives everything else. And to be clear, approaching retirement doesn't mean eliminating equity exposure. It means aligning assets with time horizon. Money needed in the next decade should not be dependent entirely on market recovery. Money needed 15 to 20 years from now can afford that volatility. This segmentation does 2 things. It protects lifestyle in downturns, and it preserves growth where time exists. Too aggressive and early declines create damage. Too conservative and inflation erodes purchasing power over that decade. So balance is strategic. It's not emotional. Even with a smart allocation, there's another lever that quietly determines longevity: spending behavior. Rigid withdrawal rates increase pressure during downturns. Flexible withdrawal rates, well, can help to increase that resilience. So if markets decline, and temporarily reducing discretionary spending can help to preserve capital. So even small adjustments early can materially extend the portfolio survival. The retirees who maintain confidence through volatility aren't necessarily those chasing the highest returns. They're the ones controlling what they can control. And spending flexibility is one of the most powerful levers available. Here's the uncomfortable truth. Many investors enter retirement with an accumulation strategy still in place. High equity concentrations, undefined liquidity buffers, and rigid withdrawal assumptions. It feels fine until volatility appears early. And if early volatility meets withdrawals without structure, the compounding damage is real. Recovery time is no longer unlimited. Markets don't coordinate with retirement dates. That's just arithmetic, not pessimism. Volatility feels different when income depends on your portfolio. And so headlines will start to feel louder, losses will feel more personal, and that's why structure must support discipline. You need a visible cash runway, a defined rebalancing rules, clear income mapping, pre-committed adjustment thresholds. So if your strategy requires perfect emotional control during chaos, it's fragile. If your structure anticipates volatility, well, then your confidence increases. Because most permanent damage isn't market-driven, it's decision-driven. This stage of life isn't about maximizing returns. It's about minimizing the irreversible mistakes that you can make. Capital preservation isn't defensive thinking, it's intelligent positioning when recovery time narrows. Growth still matters, but growth without guardrails introduces risks that may not be repairable. The goal is not to avoid volatility, it's to survive it without compromising lifestyle or legacy. Concern becomes clarity. Clarity becomes control, and control becomes the confidence you'll have. A confidence that allows retirement to feel stable and not speculative. So if you're within 10 years of retirement or already there, this planning window deserves attention. You don't need dramatic changes. You don't need alignment. Income aligned with stability, growth aligned with time horizon, spending aligned with flexibility, and risk aligned with reality. When those pieces connect, market cycles become manageable and wealth becomes durable. If you'd like to structure a review of how your portfolio would handle early retirement volatility, there's a link below. We can walk you through income structure, liquidity runway, and allocation alignment. No urgency, because clarity compounds.